Right now, Bitcoin is sitting on a price shelf that has only existed a few times in its entire life. A shelf where people wake up rich, and where people wake up wrecked. And here's the part nobody wants to say out loud. The next move is not going to be polite. It's going to be violent. One direction, one break, and the market will decide who is trading a plan, and who is trading a feeling. Bitcoin is not drifting, it is coiling. It is compressing under a ceiling, leaning on a floor, and building pressure like a spring that's been held down too long. And if you are still waiting for a random tweet, a random headline, or a random influencer to tell you what happens next, you're already late. Because the chart is already talking. Today I'm going to decode it in plain English. No hype, no fantasies, no $200K by Friday. Just structure, levels, and signals, so you can see the road before the headlights hit it. Welcome back. Let's get into it. Bitcoin is trading around the mid-$66,000. That number by itself is meaningless. What matters is what that number is trapped between. Because this market is not a straight line. It's a battlefield. And right now the battlefield has three numbers you need to burn into your brain: the floor, the trigger, and the ceiling. The floor is the $60,000, $62,000 corridor. The trigger is $66,000. The ceiling is $72,000, $75,000. Everything else is noise. Here's what just happened in one clean sequence. Bitcoin dumped into the $60K area, hit real demand, and bounced hard. That bounce was not imaginary. That was a defense. That was buyers stepping in and saying, "Not here." For a moment, the crowd celebrated. The timeline filled with victory laps. The thumbnails screamed, "Bitcoin is back." But then the bounce did what weak bounces always do. It started slowing down. It started stalling under resistance. And each push upward started getting rejected faster. Lower highs, smaller rallies, less follow-through. That is not a comeback story. That is the market testing the ceiling and failing. And when a market keeps failing at the same ceiling, it's not just taking a break. It's revealing a power imbalance. Now here's the reason you need to lock in for the full breakdown. Because this is a decision zone. A fork in the road. Bitcoin is either going to snap upward and reclaim the entire structure, dragging late shorts into a squeeze, or it's going to lose the trigger level, roll over, and drag late longs into a liquidation wave. And the chart is leaving footprints. Let's start with the daily chart, the big picture, because that's where the truth lives. On the daily, Bitcoin is still trapped beneath prior peaks and beneath a stack of overhead resistance that hasn't been cleared. Price is compressing. The market is building what looks like a descending formation, lower highs pressing down while support holds up. That is a classic pressure cooker. People love calling it consolidation because it sounds calm. It's not calm. It's tension. Now the daily levels that matter. Major support, $60,000 to $62,000. This is the floor of floors, the line that has historically attracted large bids, the zone where long-term holders defend, and where the market decides whether this is a correction or a structural breakdown. If Bitcoin loses that corridor, the story changes instantly. Intermediate support, roughly the upper 65Ks into the high 67Ks. This is the cushion zone where price is hovering now. It's holding, but it's fragile. Because support is not a wall. Support is a memory. And every time you test that memory, it fades. Major resistance, $72,000 to $75,000. This is the ceiling band, the area where sellers have repeatedly stepped in, the zone that has turned rallies into pullbacks. And the key number inside that band is $75,000. Not because it's magical, because it's structural. A clean daily close above $75,000 doesn't just look bullish, it breaks the bearish posture. It flips the formation. It forces the market to reprice the entire swing. Until that happens, the market is still healing, not trending. Now zoom into the 4-hour chart, because that's where the short-term psychology is visible. After the bounce from 60K, Bitcoin didn't transition into clean higher highs. It transitioned into sideways action with descending peaks. In plain English, every rally attempt is weaker than the last. That matters. Because strong markets don't struggle to rally, they rip. Weak markets struggle. They climb like a tired runner, and then they collapse under their own weight. On the 4-hour, the zones are clear. Support, the mid-66,000s down into the high 65,000s. Resistance, the low 72,000s into roughly $73,000. And there's a trigger inside the trigger, the $70,500 area. If Bitcoin can print a decisive 4-hour close above the low 70Ks with expanding participation, meaning volume actually shows up, that changes the tone. That's not a random bounce, that's a breakout attempt. But if Bitcoin loses $66,000 and closes below it with momentum, the market isn't cooling off, it's rolling over. And the next magnet becomes that $60 to $62K corridor again. This is where traders get chopped to pieces, because this phase is mean reversion. Price snaps up, snaps down, and punishes impatience. If you are trying to scalp every wiggle, the market will eat you alive. This is a patience market. Now let's talk indicators, because this is where the chart stops being emotional and starts being mathematical. First, RSI. RSI is sitting in the mid-30s, around 36. That is not panic. It is not screaming oversold, which means you don't have that classic rubber band snap setup where the market is stretched and begging to rebound. But it's also not overbought, so you don't have an overextended top. You have neutrality leaning weak. That's what RSI is saying. Second, stochastic. Stochastic is basically parked near the middle of the range, around 48. That is indecision in oscillator form. Third, CCI. CCI is slightly negative, around minus 47. Not extreme, not a crash reading, not euphoric. It's equilibrium with a bearish tilt. Now the one indicator that should make you sit up, ADX. ADX is high, around 57. ADX measures trend strength, not direction. So when ADX is elevated while price is printing lower highs, that tells you something uncomfortable. The downtrend energy from the prior peak still has structural strength. The market is not fully reset. The bulls have not fully broken the spine of the prior move. Now add the momentum tools. The awesome oscillator reading is positive on paper, around 1127, but it's registering neutral on the signal scale. The key point, it isn't accelerating downward, which is mildly constructive. Momentum is still negative, around negative 453. MACD is still negative, around negative 43. But here's the nuance most people miss. Both of these can stay negative while the downside pressure fades. Negative with improvement means selling pressure is waning. It means the market is tired, not dead. But tired does not automatically become bullish. A tired bear can still swipe. Now the moving averages, the heaviest weight on this entire chart. Bitcoin is trading below the major moving averages across the board. That is the reality. It's below the short-term EMAs, below the mid-term EMAs, and below the long-term anchors. Even the levels you might be close to are still overhead. And what that creates is a ceiling made of layers. Think of it like climbing stairs that are covered in ice. Every step up is resistance. Every moving average above price becomes a place where sellers can lean. So for Bitcoin to reclaim a truly bullish posture, it doesn't just need one green candle. It needs a sequence. It needs to reclaim levels one by one, with time and participation. That's why the "it's going to the moon tomorrow" crowd always gets wrecked in this phase. Because healing is a process, not an event. Now we've done the work. So here's the verdict, and I'm going to give you both sides because one-sided analysis is propaganda. First, the bull case. For the bulls to win, Bitcoin has to do two things, cleanly. Number one, it has to reclaim $72,000, $73,000 with a real breakout attempt, not just a wick. Number two, it has to confirm the big level, $75,000, with a decisive daily close. If that happens, the descending structure gets invalidated. The ceiling band becomes the rearview mirror, and the market opens a lane back toward the 80Ks and beyond, because once you break a structure like this, trapped sellers become fuel. Shorts cover, sideline money chases, and the chart stops being a warning sign and starts being a launch pad. But the bull case has a requirement the crowd hates: patience. You don't front-run the breakout, you wait for it to print. Now the bear case. If Bitcoin breaks and closes below $66,000, the current stabilization phase is over. Not maybe, over. That break turns the cushion into a trap door, and the market gets pulled back toward the major support corridor at $60,000, $62,000. And here's the brutal truth. That corridor has already been tested. Support gets weaker with each test. The first test is strength. The second test is stress. The third test is often failure. So if we lose 66K, tag 60K again, and the bounce is weak, the market starts whispering a word people hate: capitulation. Now let's address the scary question hiding behind this entire range. What if this sideways action is not accumulation? What if it's distribution? Distribution is when large players sell into stability. Price looks calm, retail relaxes, and then the floor drops out. Do we have proof that's happening? No. But do we have signals that make it possible? Yes. Lower highs on the 4-hour, weaker rallies, moving averages overhead, oscillators not resetting into deep oversold where reversals often ignite. That combination can fit distribution. So if you are bullish, you don't get emotional about it. You respect the risk. Now, what do I think is most likely in the immediate near term? More chop, more range, more mean reversion between roughly $66,000 and the low 72,000s. Why? Because volatility coils before it releases, and this coil is tight. But here's the non-negotiable truth about coiled volatility. It always resolves. The spring always snaps, and when it snaps, it doesn't move in slow motion. So your job is not to predict the snap with ego. Your job is to define the triggers and react with discipline. Here are your triggers. Bull trigger, a 4-hour close above the low 70Ks with clear participation, followed by price reclaiming $72-73K. Confirmation trigger, a daily close above $75K. Bear trigger, a clean break and close below $66K with momentum. And if that bear trigger fires, you watch the $60K, $62K corridor like your life depends on it. Because that's where the market decides whether this is a reset or a breakdown. Now I want to zoom one more level in because a lot of people get the daily and the 4-hour right and still get wrecked on execution. They understand the map, then they lose the fight inside the chop. Because the 1-hour chart is where the market plays games. This is where liquidity gets hunted. This is where stops get vacuumed. This is where you see a clean push, you chase it, and 10 minutes later it reverses, and you're staring at a red position wondering what you missed. On the 1-hour, Bitcoin has been oscillating around that $66K to $68K neighborhood, printing quick spikes up and down, then snapping back into the range. That behavior is not random. That behavior is the market collecting inventory. Every time price pokes higher and fails, it leaves trapped buyers above. Every time price pokes lower and bounces, it leaves trapped sellers below. And trapped traders are fuel. When the range finally breaks, the fuel ignites. That's why the next move won't be gentle. Now let's talk about the moving average wall with more clarity, because this is the silent reason rallies feel heavy. Short-term averages are still above price. Mid-term averages are stacked above those. And the longer anchors sit even higher, like a roof made of layers. You don't have to memorize every exact number to understand the message. Overhead supply is layered. Every time Bitcoin rallies into that stack, it meets sellers who are trying to exit at better prices, funds that sell strength, and systems that mechanically reduce exposure near moving average clusters. So the market climbs like it's running uphill. But here's the twist. Moving averages are not permanent ceilings. They flip. When price reclaims a key average and holds above it, that average becomes support. That's how a real transition begins. It doesn't happen with one green candle and a viral thumbnail. It happens with a sequence. Reclaim, hold, build, then extend. Now let's define what real looks like so you don't get faked out by a liquidity sweep. A real breakout has 3 ingredients. 1. The close above the level, not just a wick. 2. The retest that holds. Price comes back, taps the breakout zone, and buyers defend it. 3. Participation. Volume expands and the move doesn't instantly get sold. If you don't have those 3, you might be watching a trap. Because markets love breaking levels by $5, triggering entries, then snapping back and wiping out confidence. Now flip it to the downside. A real breakdown also has a recipe. 1. A close below 66K. 2. A failed reclaim. Price tries to get back above and gets rejected. 3. Acceleration toward the next magnet, which is that 60 to 62K corridor. If that sequence starts printing, you don't argue with it. You respect it. Because arguing with a breakdown is how accounts disappear. Now here's the most important psychological point of this entire video. The range is designed to punish both emotions. FOMO makes you chase the first green candle. Fear of being wrong makes you hesitate when confirmation finally prints. Both are traps. The solution is mechanical. Define the levels, define the confirmations, and only risk when the market earns it. And remember, the market doesn't need to fool everyone. It only needs to fool the most emotional traders. That's why you'll often see a fake breakout above resistance, a quick pump that feels like the move, and then a sharp reversal that slams price back into the range. Or a scary breakdown below support, a quick flush that feels like the crash, and then a violent snapback that traps late shorts. These are not accidents. They are liquidity events. So if you want one simple rule, it's this: don't trade the first touch. Trade the confirmed close and the held retest. Now the cliffhanger. If Bitcoin breaks above $75K with a real daily close, it doesn't just trigger retail excitement. It triggers systems, trend followers, momentum funds, the money that waits for confirmation and then moves size. That's how you get the fortunes made overnight move. But if Bitcoin breaks below $66K, revisits $60K, $62K, and the bounce is weak, the market starts whispering a word people hate: capitulation. And you don't want to be learning that lesson in real time. You want to be prepared before it happens. If you've made it this far, here's your quick action map, and it's simple. If price is inside the range, you respect the range. If price breaks above the ceiling with confirmation, you respect the breakout. If price breaks below the trigger with momentum, you respect the downside risk. No emotions, no revenge trades. No, it has to go up because I want it to. The chart doesn't care what you want. Now here's the cliffhanger that matters. The market is not going to give you a polite signal. It's going to give you a punch. One candle, one break, one cascade. And the people who survive are the ones who already decided what they will do before it happens. So right now, before the next move, set your levels. Write them down. $66,000, $72,000 to $73,000. $75,000, $60,000, $62,000. Those are the gates. Above the gate, momentum shifts. Below the gate, risk accelerates. And the moment Bitcoin chooses a gate, the rest of the market will follow. If this breakdown helped you see the chart with clarity, do one quick thing for me. Subscribe. Short, simple, and it helps you stay ahead of the next move when it hits. And drop a comment because I want to know how you're reading this. Do you think this range is accumulation or distribution? And which level do you think breaks first? $75K to the upside or $66K to the downside? Because the answer to that question is going to decide who's celebrating and who's coping. Stay sharp, stay patient, and don't let the range steal your discipline.